Well, hello there, my sleepy friends. Get comfortable now. We're going to talk about something that once shook the whole world. Not an earthquake, not a storm, but something quieter. Numbers, promises, trust, and how all of that broke down. This is the story of the 2008 financial crisis. Let's start at the beginning. It's the early 2000s. Life feels full of possibility. Interest rates are low. Banks have money to lend. Everyone wants the same shiny dream, a house of their own, something solid, something safe. Banks say, sure, we can help with that, even if you don't have much savings. Even if your job isn't steady, they still say yes. These loans are called mortgages, and soon they're being handed out like candy. Some of these mortgages are good, some are risky. The risky ones get a special name, subprime loans. Subprime means not the best, but there was a lot of profit to be made. And profit, you see, can make people forget risk. Now imagine this. A banker gathers up thousands of these mortgages, good ones, bad ones, all mixed together, and ties them up in a neat little bundle. That bundle gets a fancy name, mortgage-backed security. Other investors buy these bundles, believing they're safe. Why? Because trusted rating agencies, the ones who were supposed to judge risk, gave them top marks, a AA, the best. It was as if someone labeled a banana diamond, and everyone just nodded. Banks sell, investors buy, money flows, the market hums, the prices of homes climb higher and higher. It feels unstoppable. But housing prices can't rise forever. They never do. Slowly, life catches up. People who took out risky loans can't pay them back. One house goes into foreclosure, then dozens, then hundreds. The mortgage bundles start losing value. Investors get nervous. Banks start looking at each other and wondering, wait, how many of your loans are bad? Trust cracks, credit freezes, money stops moving. In 2008, the illusion shattered. Lehman Brothers, once a titan, fell. In its wake, panic. Banks clutched their cash. Credit markets froze. The stock market plunged. Everywhere, people watched the same headlines, glowing on phones and televisions. As savings evaporated before their eyes, factories slowed, businesses shuttered, millions lost jobs, homes, and hope. A global economy built on confidence suddenly forgot how to trust. In the fall of 2008, the heartbeat of the financial system nearly stopped. Banks froze, credit vanished, fear spread faster than facts. Inside the crisis, one institution became the steady hand, the Federal Reserve. The Fed slashed interest rates to nearly zero. It pumped billions, then trillions into the market, not to make anyone rich, but simply to keep the blood flowing. Programs with cryptic names, TAF, TALF, QE, all designed to restore trust. It was triage on a global scale, an economy on life support, and slowly, the patient began to breathe again. The Federal Reserve could lend, but real healing needed more than liquidity. It needed confidence. In Washington, a controversial rescue plan emerged, the Troubled Asset Relief Program, or TARP. The U.S. Treasury poured hundreds of billions into stumbling banks, insurance firms, and automakers. The message was simple. We can't let everyone fail at once. People were furious. It felt unfair, but without it, the economy might have entered a dark age. Sometimes survival looks like surrender. Across the ocean, other nations scrambled. Europe launched emergency funds to save its own banks. China unleashed a massive stimulus. Roads, railways, entire new cities built almost overnight. Every central bank on earth began cutting rates, pouring oxygen into the same fire. The world realized just how intertwined it had become. Finance was no longer national, it was planetary. And when one heart faltered, everywhere felt the ache. While the headlines told tales of bailouts and billions, the streets told quieter stories. Families left homes behind, their lawns uncut, their mail uncollected. Entire neighborhoods became ghosts of prosperity. Jobs vanished, 401ks shrank. Every paycheck felt temporary. In coffee shops and living rooms, people whispered the same phrase, "What happens now?" The economy was recovering on paper, but in kitchens and classrooms, fear lingered. Beneath the surface, economists and bankers rewrote the rules of stability. They created stress tests for large banks, imaginary storms to see if a system could weather another collapse. They mapped the arteries of credit, tracing where risk hid. They built new tools, new safeguards, as if patching a hull mid-voyage. It wasn't glamorous. There were no parades for the accountants, but slowly, quietly, order returned. Recovery didn't heal resentment. People watched Wall Street bonuses return while foreclosure signs still dotted the suburbs. In 2011, protesters gathered under rain-darkened tarps in a small Manhattan park. Occupy Wall Street, a movement born of disillusionment. Their chant was simple, "We are the 99%. It echoed across cities around the world, a reminder that statistics are never the same as fairness. The financial system had survived, but its reputation had not. Politicians answered the outrage with policy. The Dodd-Frank Act became the new backbone of regulation. Banks had to carry thicker cushions of capital, trade less recklessly, and submit to deeper oversight. The wild frontier of finance became fenced and patrolled. Wall Street grumbled. Washington watched. The public hoped it wasn't just theater. For the first time in decades, the invisible hand of the market found itself wearing a seatbelt. Years passed. The stock market climbed again. Housing prices rose. People began buying, hiring, building, living. Confidence crept back like spring thawing winter ground. Yet something had changed. The sparkle was gone. The next generation viewed money differently. It saved more, borrowed less, asked harder questions. The recovery was not just economic, but psychological. Out of the ruins, new ideas quietly bloomed. Digital money, Bitcoin, once dismissed as a curious experiment, found believers who distrusted traditional banks. Startups promised disruption. Technology claimed it could make systems transparent again. The sharing economy, the gig economy, new forms of earning, born in the shadow of old systems that had cracked. Necessity turned to invention. In the ashes of crisis, innovation slept with one eye open. The crash didn't just change markets, it changed societies. Years of slow recovery bred skepticism of governments, of experts, of truth itself. Populist movements rose from both ends of the spectrum. Blame shifted from bankers to bureaucrats to neighbors. Elections across the 2000s carried echoes of 2008's frustration. People wanted simplicity in a complicated world. The aftershock of lost trust reshaped entire decades of democracy. 15 years on, the charts have healed. But the memory still hums quietly beneath every forecast. When new markets wobble, cryptocurrencies, real estate, technology bubbles, voices return to that old refrain. Could this be another 2008? The crisis lives on as a compass, a warning in every boardroom, a ghost in every policy debate. Its greatest lesson wasn't about greed or regulation. It was about fragility, the delicate balance between confidence and collapse. The system survived. So did we. From the Federal Reserve's frantic midnight meetings to the hum of calm markets today, the story has come full circle. In every number, every deal, there's still a pulse, the faint echo of the moment the world almost stopped. And now, as night settles over glowing city towers, the markets sleep again. History exhales, softly, steadily, a new day waits. Well, hello there, my sleepy friends. Tonight, we're going to wander through the quiet history of one of the most powerful and least understood institutions in the United States, the Federal Reserve. A name that sounds steady, official, almost inevitable. But the Federal Reserve was not inevitable. It was created out of panic, out of fear, out of repeated financial collapses, bank runs, frozen credit, and the uneasy realization that the country had become too large, too industrial, and too financially tangled to keep relying on older, looser systems of banking. And yet, from the beginning, people disagreed about whether creating a central bank would solve America's problems or simply create new ones. So tonight, as the lights dim and the world grows quiet, let's go back to the long years before the Fed existed, back to a United States that had money, banks, debt, and ambition, but no true modern central bank. To understand why the Federal Reserve was created, we have to begin with a recurring pattern in early American history, the pattern of financial panic. Again and again, during the 19th century, the American economy lurched between expansion and collapse. Boom, speculation, easy credit, then fear, then contraction, then bank failures, then unemployment, then a long, uneasy recovery. The United States had banks, of course. It had state banks, national banks, private financiers, clearinghouses, and a growing web of credit relationships. But it did not have a stable, flexible central authority ready to act as a lender of last resort when panic set in. And that absence mattered, because banking systems do not only fail when they are insolvent, they can also fail when people become afraid. If enough depositors rush to withdraw their money at once, even a bank with decent long-term assets can collapse under the immediate pressure. Banking, in a strange way, rests on confidence, and confidence is often quiet until it breaks. Throughout the 19th century, the United States experienced major financial panics, including those of 1819, 1837, 1857, 1873, and 1893. Each panic left behind the same unsettling question: who exactly was supposed to stabilize the system when fear took over? For a long time, the answer was messy. Sometimes private actors stepped in. Sometimes clearinghouses improvised emergency measures. Sometimes governments did very little. And sometimes the country simply endured the pain. This was not because Americans were indifferent. It was because they were divided. The United States had a long and suspicious relationship with central banking. There had been earlier national banks, the First Bank of the United States and the Second Bank of the United States, but both were politically controversial. To supporters, a national bank could help stabilize finance, improve credit conditions, and bring order to an unruly monetary system. To critics, it looked like concentrated financial power, too distant, too elite, too intertwined with political interests, too capable of favoring some regions or classes over others. Andrew Jackson's war against the Second Bank in the 1830s left a lasting cultural mark. For many Americans, especially in the decades that followed, suspicion of central banking became part of the national political instinct. And so the United States entered the late 19th century as a growing industrial giant with a fragmented banking system and no permanent central bank. This arrangement worked until it didn't, and when it failed, it often failed dramatically. As railroads spread, cities expanded, corporations grew larger, and financial markets became more interconnected, the weaknesses of the old system became harder to ignore. The economy was modernizing rapidly. The banking framework was not. Money could be scarce when it was needed most. Seasonal demand for cash, especially around harvest time, could strain the system. Banks were subject to legal and structural limits that made them less flexible than they might otherwise have been. And because reserves were unevenly distributed, pressure in one part of the financial system could spread quickly. What America had was not chaos exactly, but it was something brittle, a structure that could look acceptable in ordinary times and suddenly look dangerous in extraordinary ones. And then came the Panic of 1907. This is the event that sits, like a low bell tone, beneath the creation of the Federal Reserve. In 1907, a financial panic shook the United States after a failed attempt to corner the stock of United Copper Company helped trigger broader fear. Trust companies came under pressure, the stock market fell, and panic spread through New York's financial system and beyond. In the absence of a central bank, the response depended heavily on private intervention, most famously from J.P. Morgan, who helped coordinate support for endangered institutions. There is something almost cinematic about this moment. A private banker in a crisis gathering other financiers into rooms late at night, reviewing balance sheets, deciding who might be saved, who might not, and how to contain the panic. It was dramatic. It was effective to a point, and it was also unsettling because it suggested that in moments of national financial emergency, the country was relying not on a public institution with a formal mandate, but on the prestige, judgment, and coordination of one extremely powerful private man. That was not a comforting long-term solution. The Panic of 1907 convinced many policymakers that the country needed something more systematic, not just emergency heroics, not just improvisation, a structure, a reserve system, a mechanism that could provide liquidity in crises and reduce the risk of collapse spreading unchecked. After the panic, Congress created the National Monetary Commission to study banking reform. Lawmakers, economists, and financial leaders looked closely at banking systems in Europe, where central banks played a larger stabilizing role. But even then, the idea of an American central bank had to be handled carefully. The word itself carried political danger. Too many Americans feared Wall Street domination. Too many feared federal overreach. Too many feared that a central institution would become either a servant of private finance or a tool of centralized political power. So when reformers moved toward a new system, they had to build something that looked, and in some ways truly was, more decentralized than the great European central banks. And this is how we arrive at one of the most distinctive features of the Federal Reserve. It was designed as a compromise, not purely public, not purely private, not fully centralized, not fully regional. The structure reflected America's distrust of concentrated power almost as much as its desire for financial stability. In 1913, after years of debate, Congress passed the Federal Reserve Act, and President Woodrow Wilson signed it into law. The United States finally had a new central banking system, or rather, something close to one, because the Federal Reserve was not created as a single towering institution in the way many people imagine. It was created as a system. Regional Federal Reserve banks would be established around the country, with a governing board in Washington. This was deliberate. The designers wanted a balance between national oversight and regional representation. They wanted bankers involved, but not fully in charge. They wanted public legitimacy, but also technical competence. They wanted elasticity in the money supply, stronger reserve management, and a way to respond to panics. At its core, the new system was meant to solve a few recurring problems, to furnish a more elastic currency, to improve supervision and reserve coordination, and to provide a lender of last resort function in times of stress. That sounds tidy. In practice, of course, institutions are never quite as tidy as the laws that create them. The Federal Reserve began operating in 1914, and almost immediately, history accelerated. That same year, World War I began in Europe. The new institution was still young, still learning its own structure, still finding its footing, and already the global financial environment was shifting around it. Wars have a way of enlarging state institutions. They demand financing, coordination, bond issuance, monetary adaptation, and broader administrative capacity. The Federal Reserve's early years unfolded under these conditions, and the institution's role expanded faster than its founders may have imagined. Still, the early Fed was not yet the modern central bank we think of today. Its policy tools, internal culture, and understanding of macroeconomic management were still developing, and like many institutions, it would be shaped not just by its founding mission, but by the crises that tested it. The greatest of those tests came in the 1930s. The Great Depression remains one of the defining chapters in Federal Reserve history. It is also one of the most painful. After the stock market crash of 1929, the American economy spiraled into catastrophe. Banks failed in waves, credit contracted, prices fell, output collapsed, unemployment soared, and the Federal Reserve, in the view of many later historians and economists, failed to respond adequately. This criticism became especially famous through the work of Milton Friedman and Anna Schwartz, who argued that the Fed allowed the money supply to shrink disastrously, worsening the depression rather than cushioning it. That interpretation became deeply influential. Even among people who differ on details, there is broad agreement that the Fed's actions in the early 1930s were gravely insufficient relative to the scale of the collapse. Why did this happen? Partly because the institution was still relatively young, partly because central banking theory was less developed than it is now, partly because officials were constrained by gold standard thinking, institutional fragmentation, and uncertainty about what should be done, and partly because in moments of historic collapse, people often do too little before they understand the size of the danger. The Depression changed the Federal Reserve forever, not only because it exposed weaknesses, but because it shifted expectations. After the 1930s, Americans were less willing to accept a hands-off approach to financial catastrophe. The federal government's role in the economy expanded, bank regulation increased, deposit insurance arrived, and the Fed became, over time, more firmly embedded in a larger architecture of national economic management. The lesson was harsh, but lasting. If the banking system collapses and the money supply implodes, the damage can spread everywhere. And once society learns that lesson, it rarely forgets it. Then came another global war. World War II again transformed the relationship between the Federal Reserve and the federal government. During the war, the Fed supported the Treasury's financing needs by helping maintain low interest rates on government debt. This was part of a broader wartime arrangement, and it reflected a familiar pattern. In extraordinary national emergencies, central banks often become more closely tied to fiscal demands. The immediate priority was not abstract monetary purity, it was winning the war. After the war, however, tensions emerged over whether the Fed should remain subordinate to Treasury financing needs or reclaim greater independence in pursuing monetary stability. This issue came to a head with the Treasury-Fed Accord of 1951, a milestone that is often treated as the beginning of the modern era of Federal Reserve independence. The idea of central bank independence can sound a little strange at first. After all, the Federal Reserve was created by Congress. Its leaders are appointed through political processes. It is not some floating institution detached from public life. And yet, independence in this context means a degree of insulation from short-term political pressure, especially pressure to keep money easy or rates low for immediate convenience. The basic argument for independence is simple. Politicians often have strong incentives to pursue short-term growth, cheap borrowing, or pre-election economic comfort, even if those choices create inflation or instability later. A central bank that can say no is supposed to help resist that temptation. Of course, critics see the same arrangement and draw a different conclusion. They ask why so much power over credit, interest rates, and financial conditions should sit with unelected officials. This tension is permanent, and it sits at the heart of the Fed's history. In the decades after World War II, the Federal Reserve became more recognizable in its modern role. It influenced interest rates. It shaped credit conditions. It tried, with varying success, to balance employment, growth, price stability, and financial calm. Over time, its mandate came to be understood in terms of what people now often call the dual mandate: maximum employment and stable prices. Simple words, difficult balance, too much restraint, and the economy may weaken unnecessarily. Too much stimulus and inflation may build, respond too slowly to bubbles and risk instability later, respond too aggressively and risk causing the very downturn you hope to avoid. Central banking is often described as technical, and in many ways it is. But at its core, it is also deeply human. It is the management of uncertainty. The art of acting under incomplete information, while millions of people make decisions that no committee can fully predict. And nowhere did this become more obvious than in the 1970s. The 1970s were a hard decade for the Federal Reserve's reputation. Inflation rose sharply. The old post-war assumptions seemed less reliable. The United States faced oil shocks, fiscal strain, slower growth, and a difficult mix of inflation and economic weakness, often called stagflation. This combination was especially troubling because it challenged the comforting idea that policymakers could reliably trade a bit more inflation for a bit less unemployment. Reality was rougher than that. By the end of the decade, the credibility of the Federal Reserve had been badly strained. If a central bank cannot preserve the purchasing power of money, people begin to doubt not just its policy choices, but its purpose. And so, in 1979, Paul Volcker became chair of the Federal Reserve. What followed was one of the most famous and painful anti-inflation campaigns in American history. The Fed pushed interest rates very high. The goal was to break inflationary expectations and restore confidence in price stability. It worked, but the cost was severe. The economy endured a brutal recession. Unemployment rose sharply. Factories closed. Communities suffered. Volcker became, depending on who was speaking, either the stern savior of the dollar or the cold administrator of unnecessary pain. In truth, he was part of the same tragic logic that appears again and again in monetary history. When inflation becomes deeply embedded, restoring credibility can require measures that hurt real people in the short run. That is one reason central banking so often feels morally uncomfortable. It is never only about numbers. After Volcker came Alan Greenspan, who chaired the Fed from 1987 to 2006. For many years, Greenspan was treated almost like an oracle of economic management. Inflation was lower. Growth was relatively steady. The economy seemed more stable than in earlier decades, and the Fed's reputation rose with it. This period was sometimes described as part of the Great Moderation, a stretch of reduced volatility in inflation and output that encouraged confidence in central banking. But confidence can become its own hazard. Periods of calm sometimes hide accumulating risks, and by the early 2000s, those risks were building in housing finance, leverage, and the broader financial system. Then came 2008. The financial crisis of 2008 was, in many ways, the Federal Reserve's defining challenge since the Great Depression. Major institutions came under pressure. Credit markets seized up. Panic spread through the financial system. The risk was not merely that some firms would fail, but that the system itself could freeze. And here the Fed responded far more aggressively than it had in the early 1930s. It cut rates sharply, created emergency lending facilities, worked alongside other agencies and institutions to stabilize markets, and later, under Ben Bernanke, it pursued large-scale asset purchases, often referred to as quantitative easing. To supporters, these actions helped prevent a far worse collapse. To critics, they looked like bailouts for powerful financial institutions, a rescue that stabilized Wall Street while leaving ordinary people to bear the long aftermath. Both views contain part of the truth. The Fed did act to prevent systemic collapse, and many people did feel, not irrationally, that the financial system was protected more quickly than households were restored. The crisis deepened public attention to the Federal Reserve in a new way. It was no longer just a distant institution adjusting rates in the background. It had become visible, and once power becomes visible, scrutiny intensifies. In the years that followed, the Fed remained central to debates over recovery, inequality, inflation, asset prices, labor markets, and the limits of monetary policy. Then, during the COVID-19 pandemic, it again intervened on a massive scale as economic life suddenly froze and financial panic threatened to spread. Rates fell, facilities opened, balance sheets expanded, emergency support moved quickly. The modern Fed had become, in effect, a crisis manager of extraordinary reach. And this returns us to the deepest question in its history. What is the Federal Reserve supposed to be? A neutral stabilizer? A lender of last resort? A guardian against inflation? A steward of employment? A protector of financial markets? A technocratic institution standing above politics? Or a powerful actor whose choices are inevitably political, whether it admits that or not? The truth is that the Federal Reserve has been all of these things in different proportions at different times, and that is why it remains controversial. Its defenders say that modern economies need a central bank. Without one, financial panics can spiral, liquidity can vanish, and recessions can become depressions. Its critics say concentrated monetary power is dangerous, that the Fed distorts markets, socializes risk, rewards leverage, enables government borrowing, or claims a kind of technical neutrality that hides profoundly political decisions. These arguments are not new. They echo the fears that were present at its birth. Fear of panic on one side, fear of concentrated power on the other. The Fed was created in the space between those two fears, and it still lives there. If we step back and look at the whole story, the shape of it becomes clearer. The Federal Reserve was born because the old banking system was too fragile. It grew because crisis kept expanding the demands placed upon it. It was criticized for doing too little in the Depression, then shaped into a stronger modern institution through war, reform, and changing economic theory. It fought inflation in the 1970s and early 1980s with painful force. It gained prestige in calmer decades, then became a crisis firefighter again in 2008 and 2020. At every stage, it accumulated not just tools, but expectations. And expectations are a form of burden. Once a society comes to believe that its central bank should prevent collapse, stabilize prices, support employment, calm markets, and preserve confidence, the institution becomes something larger than its founders imagined. Not omnipotent, but central, quietly central. Like plumbing, you only notice when it breaks. Like a foundation, you only think about when the house shakes. And perhaps that is why the Federal Reserve can feel both obscure and strangely intimate. Most people do not follow its meetings closely. Most people do not read its balance sheet. Most people do not spend evenings thinking about reserve requirements or open market operations. And yet the Fed's decisions reach into mortgages, job markets, business loans, savings accounts, pensions, inflation, and the broad emotional weather of the economy. A rate cut can feel abstract in Washington and very real in a kitchen. A tightening cycle can sound technical on television and deeply personal in a town losing jobs. This, too, is part of its history. The Federal Reserve is not only an institution of economists and bankers, it is an institution whose choices ripple outward into ordinary life. And so, tonight, if we imagine the history of the Fed as a series of quiet rooms, we might see it like this: a 19th century bank trembling under the pressure of withdrawals, a group of financiers in 1907 reading ledgers by lamplight, lawmakers arguing over how much power should be centralized and how much dispersed, a new reserve system opening its doors just as the world tips into war, Depression-era officials watching failure spread faster than their confidence, post-war planners debating independence, Volcker holding the line against inflation at immense human cost, traders in 2008 staring at screens as markets seize, and through it all, the same old problem returning in new forms. How do you build a monetary system that is flexible enough to survive panic without making it so discretionary that people no longer trust the restraint of those in charge? That is the Fed's central puzzle. Not one it has solved once and for all, one it keeps inheriting. As we close, it helps to remember that institutions like the Federal Reserve are born from contradiction. People want stability, but they also want freedom. They want money to hold its value, but they also want credit to be available. They want rescue in crisis, but they dislike concentrated power. They want expertise, but they distrust elites. They want someone to act when panic spreads, but they worry about what that actor becomes over time. The Federal Reserve exists because these desires do not easily fit together. Its history is the history of trying to hold them in balance, sometimes wisely, sometimes clumsily, sometimes too timidly, sometimes too boldly. It was created to make panic less devastating. It was reshaped by depression, tested by war, humbled by inflation, expanded by crisis, and watched, always, by a public that needs it and doubts it in almost equal measure. That may be the most enduring part of its story. Not that it inspires trust, not that it inspires suspicion, but that it inspires both. And perhaps that is unavoidable for any institution given power over something as strange and sensitive as money. Because money is never just economics. It is confidence, memory, promise, fear, and the Federal Reserve sits at the center of all of them, quietly adjusting levers in the dark, while the rest of the country sleeps, borrows, saves, spends, worries, hopes, and wakes into whatever economy comes next. And tonight, from a distance, that long history softens a little. The panic rooms fall silent, the ledgers close, the marble buildings go still, the trading floors dim, and the story of the Federal Reserve becomes what all history becomes, eventually. A record of people trying to create order in a world that never stays ordered for long. Sleep well. Well, hello there, my sleepy friends. Tonight, we're going to drift slowly through one of the quietest and most surprisingly dramatic stories in economic history. It's the story of the gold standard in the United States. Not just what it was, but how it worked, why people trusted it, why governments struggled to keep it, and why eventually the country moved away from it. So settle in, dim the lights, take a slow breath in, And let's wander back through old mints, dusty ledgers, heavy coins, war finance, train lines, bank vaults, and a summer evening in 1971 when the final link between the US dollar and gold was cut. Imagine, for a moment, a world where money is not just paper and numbers on a screen. A world where a dollar is tied in some formal way to a physical thing, something dug from the earth, something heavy, finite, and glittering, gold. For many people, the gold standard sounds simple. The phrase brings to mind a kind of old-fashioned certainty, a stronger money, a steadier world, a time when a government couldn't simply create more currency whenever it wanted. But the real history is softer around the edges than that, more complicated, more human. And in the United States, it did not begin with a neat golden rule from the very start. In fact, the early American monetary system was not originally a pure gold standard at all. The country began with a bimetallic system, meaning the dollar was defined in relation to both silver and gold under the Coinage Act of 1792. For much of the early republic, the practical standard shifted depending on market conditions, and for long stretches, silver functioned more prominently than gold. That's an important place to begin, because if we want to understand why the United States left the gold standard, we first have to understand that it took a long time to fully arrive there. In the beginning, the young United States was trying to build trust in its government, trust in its laws, trust in its money. The founders knew that money mattered, not just as a tool of trade, but as a symbol of stability. A nation that wanted to be taken seriously needed a monetary system people could understand and believe in. So in 1792, Congress created the U.S. Mint and established the dollar as a unit tied to precious metal. But this was not yet the clean, single metal, gold standard many people imagine. It was a world of both gold and silver. Coins mattered deeply, metal content mattered deeply, and the ratio between gold and silver mattered too, because if the legal ratio set by the government didn't match the market ratio, one metal would tend to vanish from circulation while the other stayed. This was one of the quiet problems with bimetallism. It could look stable on paper while behaving unpredictably in real life. And so, early American money was already shaped by a recurring tension that would define the next 2 centuries. Should money be constrained by metal, or should it be flexible enough to meet the needs of a growing economy? That question never really went away. It only changed form. As the 19th century unfolded, the United States expanded westward, industrialized, fought over banks and central authority, and experienced repeated financial panics. Money was never just money. It was politics. It was class conflict. It was regional conflict. It was the difference between debtors and creditors, farmers and bankers, exporters and wage earners. Gold carried a reputation for discipline. Silver had its own powerful political supporters. Paper money could be useful, but also frightening. And beneath all of that sat a basic concern. If money could be created too easily, could it still be trusted? During the Civil War, that concern became impossible to avoid. The federal government, facing enormous wartime costs, issued greenbacks, paper money not fully redeemable in gold. This was a major departure from specie convertibility, and from the Civil War until 1879, fiat-style greenback money predominated nationally, even while some states remained closer to gold usage. War has a way of changing monetary rules. When survival is at stake, governments often choose flexibility over discipline, and that pattern would repeat again later. But after the Civil War, the U.S. gradually moved back toward redeemability and then more firmly into gold. By the 1870s, many countries were embracing gold monometallism, and the United States followed that broader trend. George Selgin's History for Cato notes that Germany's move toward gold helped prompt the United States to demonetize silver and enter the era of the classical gold standard. By 1879, the United States resumed specie payments, and the late 19th century became the great age of the classical gold standard. Now let's slow down here, because this is the heart of the story. What actually was the classical gold standard? In simple terms, it was a system in which the dollar was defined by a fixed amount of gold, and paper currency could, directly or indirectly, be converted into gold at that official rate. Gold was not just an investment or a shiny reserve asset in a vault somewhere. It was the anchor, the standard, the thing that gave the monetary unit its formal definition. Under a genuine gold standard, the basic unit is a specific weight of gold, and other exchange media are expected to be convertible into it. That sounds clean and solid, and in some ways it was. It imposed limits. A government could not, at least not easily, create unlimited money without risking a drain on its gold reserves. That limitation was exactly what many supporters admired. To them, gold restrained political temptation. It discouraged reckless issuance. It protected long-term confidence. And in the late 19th century, it fit neatly with a world increasingly linked by trade, capital flows, shipping routes, telegraphs, and international finance. When major countries shared a gold-based framework, exchange rates were more predictable. Merchants liked predictability. Bankers liked predictability. Investors liked predictability. The gold standard seemed to promise order, but order always has a cost. One cost was rigidity. A gold standard can help anchor expectations, but it also ties the money supply to gold reserves and to the broader behavior of banking systems that must maintain convertibility. That can become painful during crises. If confidence weakens and people rush to convert paper into gold, banks and governments can come under severe pressure. And if gold flows out of a country, policymakers may respond by tightening credit, raising interest rates, or tolerating recession in order to defend convertibility. This is one reason the gold standard has always inspired both admiration and frustration. It offered discipline, yes, but discipline does not always feel gentle, especially during hard times. In the United States, the late 19th century gold standard coexisted with recurring political battles over money. The most famous involved silver. You may remember the phrase "cross of gold" from William Jennings Bryan's 1896 speech, where he argued against forcing ordinary people onto what he saw as an unforgiving, gold-based monetary system. That conflict was about more than metal. It was about who got relief and who absorbed pain. Creditors often preferred harder money. Debtors often wanted more monetary flexibility. The gold standard was never just a technical system. It was a social choice with winners and losers. Still, the U.S. remained on gold, and in 1900, the Gold Standard Act formally affirmed gold as the monetary standard. For a while, the system endured. Then came the 20th century, with its industrial wars and mass democracies in much larger states, and that world put strains on gold that the 19th century had only hinted at. The first great break came with World War I. The classical gold standard era lasted until around World War I, when countries commonly suspended convertibility during wartime. This makes intuitive sense. War is expensive. A modern war, especially, is astonishingly expensive. Governments need to pay soldiers, buy weapons, build ships, move supplies, support allies, and do all of this faster than taxation alone can usually manage. A strict gold standard gets in the way. It says, in effect, you may spend, but only within constraints. And wartime governments rarely like constraints. So in many countries, gold convertibility was suspended or weakened. The old classical system did not survive the war intact. After the war, people did try to rebuild an international gold-based order, but it was not the same thing as before. What emerged was the gold exchange standard, a more fragile arrangement that depended more on central bank cooperation and reserve currencies. This mattered because the interwar world was not calm. It was scarred. Debts were high, politics were unstable, economies were imbalanced, and governments were now expected to manage unemployment and social strain in ways 19th century governments often were not. That made a rigid monetary anchor harder to maintain. Then came the Great Depression, and here the story becomes even more dramatic, though we'll keep our lantern light low and move through it gently. Bank failures, falling prices, collapsing demand, unemployment, fear. Under those conditions, a gold commitment could become a trap. Countries that clung too tightly to gold often found it harder to respond aggressively to crisis. In the United States, President Franklin Roosevelt took major steps in the 1930s that transformed the domestic role of gold. Americans were restricted from holding monetary gold, and the dollar's gold value was changed. The old relationship between everyday domestic money and gold became much weaker, even though gold still mattered internationally. So by the time people speak of the gold standard later in the 20th century, they are no longer talking about the same kind of world that existed in, say, 1880 or 1900. The form had changed. The meaning had changed. The system was evolving into something narrower and more state-managed. Then came World War II, and after it, the architects of the post-war order gathered in Bretton Woods, New Hampshire, in 1944. Representatives of 44 nations met there to design a new monetary framework for the world economy. This system, known as Bretton Woods, is sometimes described casually as a return to gold, but it was really something more layered than that. Under Bretton Woods, other major currencies were pegged to the US dollar, and the dollar itself was pegged to gold at $35 per ounce. So gold was still there, but now it sat behind the dollar in a special international role. This was not a system where ordinary Americans routinely walked into a bank and casually exchanged paper bills for gold coins. It was a system centered on governments, central banks, official reserves, and the dollar's role at the center of global finance. Why the dollar? Because the United States emerged from World War II in an unusually strong position. Its industrial base was intact. Its economy was enormous, and it held a very large share of the world's monetary gold. Some estimates place U.S. holdings at roughly 2/3 of the world's monetary gold by the end of World War II. That gave the United States a kind of monetary gravity, and for a time, Bretton Woods worked reasonably well. The system helped support post-war recovery, trade, and exchange rate stability. But stability in international finance often rests on hidden tensions, and Bretton Woods had a very important one. For the world to have enough reserves and liquidity, the United States needed to supply dollars to the rest of the world. But the more dollars it supplied, the more foreign holders could begin to wonder whether those dollars were really supported by enough gold. That tension later became famous as the Triffin Dilemma. Even if you don't use the term, the logic is easy to grasp. If the dollar is the world's reserve currency, the world wants dollars. If the world keeps accumulating dollars, U.S. obligations grow. If those obligations grow faster than U.S. gold reserves, confidence starts to fray. And once confidence frays, convertibility becomes dangerous, because then everyone has an incentive to redeem sooner rather than later. A quiet system can turn suddenly into a rush for the exits. By the 1950s and 1960s, the United States was facing exactly this kind of strain. It was spending heavily abroad, running deficits, financing Cold War commitments, and over time, more dollars accumulated outside the United States than could comfortably be reconciled with America's gold stock at the official price. As the Library of Congress summary of Bretton Woods notes, the system eventually collapsed because of growing pressure on U.S. gold reserves as foreign governments held increasing amounts of dollars relative to the American gold supply. Some countries became skeptical. France, most famously, was increasingly unwilling to treat dollar promises as good enough forever. Foreign central banks could still exchange dollars for U.S. gold under the Bretton Woods framework, and they did. The pressure mounted. The United States lost substantial gold reserves over these years. The problem was not that gold itself had disappeared from the earth. The problem was that the commitment to redeem dollars for gold at a fixed official price was becoming harder and harder to defend. This is an important distinction. People often say the gold standard failed, or, from the opposite camp, the government abandoned sound money. Both statements contain some truth, but each can oversimplify. What was really failing was a particular political and international arrangement, a promise to maintain a certain convertibility under conditions that had changed. The post-war world economy had grown. Dollar claims had grown. U.S. policy priorities had changed, and the arithmetic became harder to ignore. Now we arrive at the quiet climax of the story. August 15, 1971, President Richard Nixon went on television and announced the suspension of dollar convertibility into gold. The Federal Reserve's historical summary describes this as the closing of the gold window, ending the ability of foreign governments to convert dollars into U.S. gold at the official rate. It was described as temporary. It was not temporary. And this is the moment most people have in mind when they say the United States left the gold standard. Strictly speaking, or what ended then, was the final international convertibility link from Bretton Woods. The older domestic gold standard had already been transformed decades earlier, but 1971 was the final break in the chain. After that, the dollar became a fiat currency in the modern sense. no longer redeemable in gold on official demand. Its value would rest not on a fixed metal definition, but on state authority, monetary policy, taxation power, legal institutions, market confidence, and the broader productive capacity of the U.S. economy. A different kind of trust, less metallic, more institutional, more psychological, more political. Why did the shift happen? At the deepest level, because the goals of a modern state had outgrown the limits of the gold link it was trying to maintain. That doesn't mean gold had no advantages. It did. It imposed discipline. It constrained discretion. It could anchor long-run expectations. But it also restricted policy flexibility at moments when governments increasingly wanted room to maneuver. During war, depression, banking panic, or international imbalance, that room could seem indispensable. And by the mid-20th century, the United States was not just a country managing its own domestic currency. It was the issuer of the world's central reserve currency. That role created pressures the classical gold standard had never fully resolved. So the shift away from gold happened in stages. First, the early United States was bimetallic, not purely gold-based. Then the country moved into a more formal classical gold standard in the late 19th century. World War I disrupted the classical model. The interwar years weakened it further. The 1930s transformed gold's domestic role. Bretton Woods restored a more limited international gold link through the dollar at $35 an ounce, and 1971 ended even that final convertibility. That long transition is the real story, not a single switch flipped in one moment, but a slow retreat from metal-based constraint toward managed fiat money. Now, in the quiet after the history, it's worth asking what people are really debating when they argue about the gold standard today. Usually, they are not only debating gold, they are debating trust. Should trust in money be rooted in something physically scarce, or in institutions, in a metal, or in governance, in automatic rules, or in expert discretion? The gold standard appeals to people who worry, sometimes reasonably, that governments and central banks will abuse monetary freedom. Fiat money appeals to people who worry, also reasonably, that a rigid monetary system can worsen crises and force unnecessary pain. This is why the argument never fully dies. It's not just about economics. It's about what kind of constraint we believe human beings need. A gold standard says, limit yourselves in advance. A fiat system says, preserve room to respond. History offers examples that flatter both sides and embarrass both sides. Gold could stabilize, but it could also squeeze. Fiat currency can adapt, but it can also inflate. There is no monetary system made of pure virtue, only trade-offs and changing political choices. So, if you imagine the whole story as a long nighttime landscape, it might look something like this. At first, a young country sorting silver and gold into law. Then a broad 19th century road lit by the hard, steady glow of gold convertibility. Then distant thunder, war, suspension, reconstruction, depression, a redesigned world order in a hotel in New Hampshire, a dollar elevated above others, still tied to gold, but more delicately than before. Then mounting pressure in overseas claims and central bank ledgers. And finally, a president at a desk on television telling the world that the old promise would no longer be kept. Not loudly, Not with a crash of coins, just with an announcement. And after that, we entered the monetary world we still live in now. A world of fiat money, floating currencies, central banks steering by interest rates, expectations, and credibility rather than redemption into metal. A world less tangible than the old one, but in its own way, no less dependent on belief, because all money, in the end, depends on a shared story. Gold tells one kind of story, paper tells another, digital balances tell yet another. But beneath them all is the same quiet question. Why do people accept this in exchange for real things? And the answer is always some mix of habit, law, confidence, memory, and power. As we close, picture an old gold coin resting in a dark velvet tray, its edges worn smooth, its face stamped by a government long gone. Once, it might have represented certainty, or discipline, or prestige, or restraint. Now it represents history, a reminder that money is never just a neutral tool. It is a mirror of what a society fears, what it values, and what promises it believes can still be kept. And the history of the gold standard in the United States is really the history of those promises changing over time, from bimetallic beginnings to classical gold discipline, to wartime suspension, to Bretton Woods Compromise, to the final closing of the gold window in 1971. A long, quiet shift, not from reality into illusion, not from strength into weakness, not from virtue into vice, just from one set of trade-offs to another. And like so much of history, it happened gradually, then suddenly, and then it became normal. The world people once thought of as permanent became old-fashioned. The new world, at first unsettling, became ordinary. And tonight, from a distance, it all looks very still. Gold in vaults, paper in wallets, numbers in ledgers, promises passing from hand to hand, and sleep at last, settling over the whole long story.